Hey, welcome to Hub, and we're going to be doing some delta neutral trades today. And I have Jeff Beamer here ready to talk about what is going on in the market right now, a couple of his delta neutral trades that he's put on in the past, and a delta neutral trade that he's going to be looking for this week. Jeff, what are you doing today, and what is going on?
Hey, Brandon, great to be here with you. Markets are kind of quiet right now. We're looking for direction. And while markets make up their mind, we're going to be looking for trades that, specifically stocks that are acting in that quiet channeling behavior. And we're going to put a trade on later today. Towards the end of the show, I'm going to give you a trade that does just that. We're looking for the markets to remain quiet and to trade sideways. So let's jump into our market update. We're starting off with the chart of the Spider Index Trust SPY. And what I'm going to cover today is, as I go through the markets, I'm going to cover the markets with a delta neutral trading point of view, meaning I'm looking for markets that would fit certain strategies, or vice versa, certain strategies to fit certain markets. And as I see them, I will introduce them to you. We're going to go over, as Brandon said, a couple of trades, but let's start off with the broader markets. Today, we ended up 25 basis points on Spider. And what's interesting here is that we find Spider under a little bit of pressure, believe it or not. Even with this big run, let me show you what I'm talking about. Okay, if I throw on some moving averages here, now I use something very different from most traders. I use a 21 period short-term moving average and a 161 long-term moving average. All right, and you'll notice here that the Spider Index Trust SPY has pulled back right down to that 21 period moving average and is just kind of sitting right above it for right now. Now, this is a higher low, granted, but when we throw certain indicators on, for example, I throw an RSI on, this is the relative strength indicator or relative strength index. You'll notice here that we have a little bit of what we call divergence happening. Okay, we have a matching or higher high in our most recent high, and then a lower high in the RSI. All right, now that's just one indicator. So what we might be looking for is a possible close below this short-term moving average before we do anything to the bearish side. Okay, now when there is a special feature, a certain type of candlestick that I like to look at called Heikin-Ashi. This also helps me determine trend. So when I change this over to a Heikin-Ashi candle, all right, you'll notice that now we're trading red. All right, and anytime we trade red where we don't have a wick on the top, and you see yesterday or Friday, we did have that little wick. The prior candle, no wick. So red candle, no upper wick. Friday, indecision. Today, even though we traded higher, we have no wick above, just the wick below. So here we're looking for a possible continued pressure downward. And really the trade would be anything above, meaning a close, not trade, but a close above 440, and especially breaking this high of around, why don't we just say a round number like 445? A close above 445 with confirmation, which means a secondary close, I think we're going to be off to the races upward. But right now, we're in kind of a wait and hold as it relates to the Spider Index Trust. Let me bring this back down to regular candles, and you kind of get a clear vision of what we're talking about here. Really, if you're going to trade up or down, I would be waiting, okay? Just pausing just letting the market tell you which direction it's going to go. Now let's move over to the Dow Jones Industrial Average, represented by the diamonds. DIA is the symbol here for this. And as this chart pulls up, we're going to see that this has had a little bit of a deeper pullback. It's broken out of its wedge, is trading below that 21 period moving average. And I do have my line in the sand drawn here, where really for the Dow, we need to see it moving up and jumping above that 343, 344 level with confirming closes. Okay, so again, for the Dow and S&P, we're in a holding pattern right now. Not much going on. Now the Qs, the NASDAQ, that's what's been on fire of late. And believe it or not, of all the NASDAQ 100 stocks, only 7 of these stocks, remember, only 7 has driven the NASDAQ in this rocket propelled uptrend up. Okay, it's only 7 stocks. All the others have been pulling back, going sideways, not really doing much. So without those 7, that's called a narrow market. We do not have a broad-based bullish market right now. So this is why it's better possibly to be trading some of the indexes rather than individual names right now when you're trying to read what the markets are doing. Okay. Otherwise, trading those big 7 stocks. All right. So as you can see, NASDAQ sitting right on our short-term moving average. Same type of thing. We're waiting for confirmation. 2 significant closes above 370. We're off to the races. If we break below my short-term moving average, we could see a significant pullback on the NASDAQ. The initial target would be 350. In other words, if you're a short-term trader right now and you are looking to go short in the near term, this would be an easy trade. If we close below the short-term moving average, you could initiate a bearish trade on the Qs. Your stop would be at 370, but then you're going to short or go long, or go long like puts down to 350. And then if we break 350, wow, it could be a significant pullback down to 330, maybe even 320. Okay, but I would say that's fall. All right, nothing right now. I mean, we're still bullish. We're above our short-term moving average. Things look to be moving higher. All right, now the trade was long NASDAQ, short Qs. That was the pairs trade. But boy, has that been trying to reverse here recently. The small caps represented by IWM, that's what we're looking at here. What a big day, up almost 1 3/4 points on the day, 171 basis points on the day, a big move for the small caps. And that trade between long NASDAQ, short Russell may be over. And the thing is, it would move violently in opposing directions, meaning you would want to be long IWM and short the Qs if traders start to bail out of that strategy. I think they've been closing out that book of business recently as it's kind of normalized, but for the most part, watch out for the Russell and the small caps, especially as we go through earnings season. Earnings season is coming up within 2 weeks, and boy, we could really see some volatility come into play in the broader markets. Let's move on to some of the metals that we follow, starting off with gold. This is GLD. Now, we do have a delta neutral trade on gold right now, which is a butterfly to the downside. We've been looking for gold to continue this trend down. And since we entered that trade, it's really found some support and started to move sideways. But we have got this little gem of a trade sitting right down here, right around the 175 mark, that if the dollar continues to go up and gold continues to go down, That strategy that we have on, if I didn't mention it already, is called a butterfly. And we have a nice little butterfly there that's going to give us a tremendous return on risk if gold continues to drop down. So we're keeping an eye on the dollar and on the metals and looking for any kind of move to the opposite of the current trend. But right now, as you see, the short-term moving average is pointed down. The trend line that we have here, in fact, I can adjust this to a proper trend line there. You can see that today we just pressed up against that trend line. Now, how I drew that trend line, in fact, I can correct it here, is from the closes, from this high to this closing high right here, and then this open right here. All right, that is a correctly drawn trend line off a three points. All right, and you can see here that we are, well, almost looks like a wedge starting to develop here. And boy, if you listen to us on our insiders meeting on Thursday, you know how we like trading wedges. All right, and I would look for possibly a breakout to the downside with the continued move. Now, what that would take is a continued move higher in the dollar. That story is still to be written. Now, silver, so gold really didn't move much today. Silver was up a little bit, 28 basis points, still kind of doing the same thing. It found recent lows and then has just been kind of bouncing around here. You'll notice that it's below our short-term moving average and the convergence of that with our long-term moving average. And that is now providing a pretty significant area of resistance for silver. Now, there's one of those instruments that could easily break through any type of resistance very easily, but also support. Okay, so right now, really just look at trading sideways on silver and even gold for that matter in the very near term on those metals. Jumping over to the oil market with USO, we were trading down in this wedge, and then finally we broke out Friday. We had our breakout day to trade higher. But look at this today. If you look at this little wick right here, it came right up to our long-term moving average, kissed it, and then traded off of it all day, just like magic, showing some resistance on crude. So we have had a little bit of rally in the oil markets over the past 2 weeks. And that's pretty easy because it was under quite a bit of pressure. It did form this wedge, but now we have this breakout. What I would say is if we get a closing high, another closing high on crude oil in the next 2 to 3 days, we would go long, and our target would probably be $70. Okay, would be $70. That would mean a close above the long-term moving average here. Now, the reason I say that is because I drew a line in the sand here, and that's this downward sloping trend line here. We had a close, okay? That close is what we call the signal, all right? Now, prior to that is a setup. Okay, we had this wedge forming. Stock was trading. We formed this wedge. Then we had a close above it here on the 5th. Now we had a lower close the next day, so we did not have a trigger. But Friday we had a trigger. Okay, so what I would say now after this reversal candle is I need another higher close that would confirm the uptrend, and we could be shooting up towards $70 on crude oil, breaking out of this sideways. Look how choppy it's been going sideways, trading between 60 on the low and really 67.5 on the high. In that $7.50 range, this has been trading in this range since May, and it might be time to break out of this. We shall see. Natural gas, my goodness, finally breaking out of that lull, staying above $7 for right now. It was trading down below 6 for a while, or right at 6, and we're off the highs, but we're holding this short-term moving average, holding that 21-day moving average. Now, this is the type of chart that, I would love as a delta neutral trader looking for a sideways trading stock. The problem with UNG is that the options are already priced for this move, and there's really not any premium or arbitrage available to trade here. We're just kind of keeping an eye on a possible breakout to the high side. If we can get a little bit of momentum, close below 775 with some authority, even eight would be the real number. We could see $10 really quickly. All right. And that's what we're just kind of looking for on UNG. All right, moving on to the bond market. Now, this is one area where this is showing recession. Okay, there are two areas of our economy that are showing recession, and that is the bond market and the credit market. What's not showing recession are equity markets. Okay, equity markets and housing, although housing is starting to teeter a little bit. All right, those sectors, kind of with a broad painted brush, are not showing recession. And so these two things are kind of battling back and forth. And one chart that I like to show that really shows the effect of the bond market is the 10-2 inversion right now. Now, this has been going on for a year where we have been inverted. Okay. This is called backwardation, okay, where the 2-year is paying a higher rate of return than the 10-year is, and that is not good for the markets. All right, you can see that we touched fresh lows in the spread last week. All right, right around July 3rd, we closed. In fact, down here we closed at a negative 1.08. Now, the reason why we've gone from negative 1.08 to negative 0.88 or 88 basis points is because the Fed came out and said, "Oh, we have we've certified that a bunch of these banks, our larger banks, they're all good, and the regional banks, we'll support them." Um, and so most banks, they passed the stress test. Okay. Now, the real stress test is this inverted yield curve. Last time we inverted to this level back on March 8th, we were at negative 1.07. That is when Signature Bank and Silicon Valley Bank failed. Okay, the markets, that spread just widened too much for them, and their book of business collapsed. The Feds moved in and took over those banks. We were worried that that same thing might happen again when we hit this 100 basis point mark. It sat there for a couple of days. Fed came out, supported the banks, and that's why we've seen what this is called a narrowing of the spread. The problem is we're still 88 basis points inverted, and that is recessionary. Now, when the inversion occurs, that could be up to a 2-year leading indicator into a recession. And that's what some people, including me, are very worried about right now, because now we're only 12 months in. We have a full year to watch this and watch bonds. And if they stay inverted, continually inverted, that will not be good for our markets. And you'll start to see things, you'll start to see failure in commercial real estate. Right now, they're kind of bullish on occupancy, but that might not be enough before the owners of these properties walk away from their notes. And you could see some turnover on ownership of commercial properties as a result. Okay, just one example. of why we're concerned about this. All right, so when we look at bonds, all right, we're looking at the long end of the curve, like TLT. This is the 20-year plus Treasury, and so we'll pull up TLT here. 1 second, there it is. And when TLT drops, that means interest rates are rising. Okay, and so here I had this line in the sand, and we had this close and then a second close, and look at this gap. Didn't even give us a chance to go bearish because it just gapped and ran away from us. Today it did find some support right here at $99, but that is running higher. Now this is why this big move to the downside, meaning a spike in interest rates on the 10-year, if we look at the short end of the curve, which is SHY, that's the 2-year, and that's popping up here in just a second. You'll see how it rallied a little bit today, okay? And that would, meaning rates came down on the 2-year, and that's why we went from that negative 108 to about 88 basis points, because we had a rally in the 2-year without the follow-up rally in the 10-year, and that caused a narrowing slightly of that inverted yield curve. Lastly, on a market overview, we're going to talk about the VIX real quick. We're sitting around 15 right now. That is a little bit off of our lows when we were down here around 12 and 13. But the fact that we're not spiking and we're staying below 20, really, that's, from my point of view as a long-term trader, I don't really get excited about markets until we get a VIX above 20. I mean, that really starts to generate the fear and the follow through in the broader markets. So, anyway, Brandon, as I go through these, did you pick up anything, or you have any
I mean,
observations on these
all I'm
broader
seeing
markets that
here,
we've covered?
it looks like we're more sitting on our hands a little bit right now, looking to wait for maybe this capitulation stage to kind of break free, waiting for some more confirmations on our moves, which I love to wait for those confirmations. And that last one that you
Right,
showed there, just before, I mean, there was no way to catch that falling knife quickly enough. And so even though we may have been waiting for a confirmation, still no chance to catch it, but it's still safer to wait for that
right.
confirmation than pick the wrong direction ahead of time. So that was a great recap, and I appreciate that, Jeff. What I want to hear now, I mean,
Right.
if you have a chance, maybe let's go over one of the
Yeah.
past trades that you've done over the last week here, one of those delta neutral trades that you've gotten into, and let's see what that looked
Okay,
like.
sure. Let's pop up our list of trades here. We've been on a little bit of a run here within our publication, which is a delta neutral trader publication. All right, where we apply delta neutral trades. I generate several trades a week. And lately, we've been closing out of some of those, and we have just win, win, win. And you can see our last 5 trades here: win, 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 win. And I will touch on a couple of these. We do have losers. In fact, I'm holding a loser right now that we'll be getting out of. It could become a winner, but we'll see. So let's start here with BMRN. This is a trade that we call an iron condor. Okay, now we put this on June 29th. Okay, just June 29th. All right, and you can see our legs here. We sold a vertical call on top, and we sold a bullish vertical call using puts on the bottom. I'll show you the trade as we published it here. We took in a $222 credit. Our max risk in the position was $278, and I base all these trades on a hypothetical $10,000 account. All right, so I'm going to keep our risk no more than $500 on these trades, meaning 5% of portfolio. And because of the market we've been having, I'm usually staying in between 2 and 3% a risk on our trades. But you can see here on our original setup. Now, if you're not familiar with a risk graph, these are some of the things we go through in our publication, is how to read this risk graph. But if we go through each of the 4 lines, my put spread is on the bottom. So I have the 80 put and the 85 put. and then my bear call spread is on the top, the 105 100. And we sold this one and sold this one, and that generated the credit of $222. Now, before I go away from that, you'll notice here that the trade is somewhat short term, really only 3 weeks in this trade maximum, so 22 days. However, because of certain factors, we were able to exit this trade a little early. All right. And one of those factors was the stock started to drop. Okay. And it did give me a little bit of pause. I wanted to go ahead and exit the trade before we broke below our break even, which is this light blue line down here. We were still able to capture a profit. So in roughly 1 week, we generated a 22% return on risk. All right. This $62 netted 62 basis points to our pro forma on hypothetical portfolio. So I would call this one a single. Okay. And I don't mind hitting single after single after single, because I know then I'll get a couple of doubles every now and then. I'll get the triples, I'll get the home runs, but I'm happy hitting singles, happy hitting singles. So
Singles
then
still score, right, Jeff? And I had a
singles
question on
still
that Iron
score.
Condor too, right? So
Yeah,
on those
sure.
trades,
Yeah.
do you ever close out just one side of that Iron Condor, or are you going to close the whole trade every time?
So here's the thing about that. I like so this is my style, okay? There is a lot of talk, and every now and then we hold classes for Delta Neutral subscribers and for those that are interested in trading Delta Neutral strategies. And I talk about this. There is a lot of debate over trading what's called the tested side and trading the untested side. So in this example, the calls here, you can see we sold this 100 call for 205. We bought the 105 for 98 cents. You move over to this next column on this date, okay, with 15 days left to expiration, you can see the value had dropped out of these calls. That's what we call the untested side. Some people look at, hey, I can roll that down. I've got 15 days left to expiration. I'm going to roll that down. There are other traders that say, no, you roll your tested side, okay? And you can possibly buy yourself more time by going out in time, okay? With an Iron Condor, I take the strategy from I'm all in on my original analysis, because my original analysis is usually right. Okay. And so that's just, years of looking at these charts and at trades and opportunities, so that I know that, hey, my original prognosis is usually right, and I should stick with it. So to answer your question, Brandon, I don't try to adjust, because adjustments, if they can't, they need to do the following. They need to, if I adjust, I need to either lower my risk and or increase my potential for profit. And if I can't do one or both of those, then it's not a good adjustment. Okay, reducing my risk or increasing my potential profit. Okay, sometimes I can do both with an adjustment, but oftentimes in this case, more than likely I would be adding risk and not really increasing my potential for profit by adjusting. So a long-winded answer to your question about, yeah, I'm not one that likes to do a lot of adjustments. So
Right. I actually like that better too, Jeff, because that's more of the KISS method, right? Where you just kind of set it, forget it, keep it
right.
simple, whatever method. But that also means less babysitting on the trade, which we all love. So you put that trade on, you locked it, you set it, you forget it until it's ready to close that thing out. I like that a lot better. All right, what's this next trade you got
Now,
for us? It's Verizon,
now,
right?
well, we walked right into this.
Yeah.
Listen to this
Okay.
on Verizon. This was a calendar spread. Okay, this was a calendar spread, And we put this on. We did 15 contracts. The debit on this counter spread was 13 cents. Um, One thing I like to do is make sure that I have very inexpensive trades so that even beginner traders, they can do one or two contracts, spend $13 or $26 in this example, and get themselves into a trade that could really earn them a nice return. So on Verizon, this was the setup on Verizon. We did a simple calendar spread, 13 cents. I did this 15 times, which brought my debit up to $1.95. So in a hypothetical portfolio, I'm only risking 1.95% of portfolio, and this was the setup. Okay. And all I want is for the stock to continue trading between this light blue line on top and this light blue line on the bottom, and just kind of walk itself into the profit zone. You can see profits here to the right of this vertical black line right here, profits to the right, loss to the left, and I'm looking for this stock to just walk right into this risk graph. Now, here's the crazy thing. We closed this out. So we entered this trade back on, June 13th. Okay, June 13th. And then we exited this trade on July 6th. So we were only in this trade for a couple of weeks. Now, here's the crazy thing. Here's where we exited. Okay, the dark blue line represents stock price. You can see that we started to test this upper break even, and on this little bitty pullback, I wanted to go ahead and take profits. So we exited this trade, all right, and this was the snapshot, but our fill, as you can see, was a little bit better than what's in this snapshot, all right, and we generated a very nice return for the trade. Now, you'll notice here 1 day left on that short option. Okay, 1 day left. We exited this 1 day before that short option expired. Had we waited, now here's the thing, stock could have moved up and we could have lost these profits. But let me show you what Verizon did after expiration last week. I'll pull it up here real quick. And man, this
And I knew this was gonna
here
happen because I knew
here's
this happened, and I knew this was gonna make your trade so much better had you'd stayed in it. Correct? This thing, because
I
then you would
know,
have dropped into that prime profit zone of that trade, and you would have
right
been
there
like
at $36,
right there, the
right
peak. Yeah,
right
right
on
there, the
that day.
peak. Yeah, exactly.
Look at that. We would have nailed it 1 day, and we would have had a home run trade. But
Yeah, but don't cry
hey,
about this. You got 50. I mean, what are we talking? 53.8%
we
profit on that trade. You pulled out at a safe spot, and you're able to close
yeah,
that thing, and you're happy, right?
with a
Waiting
better
that
than
one day
1%.
would have been, yeah, risky.
Oh, it would have been risky, but we were
Hmm.
able to generate a 1% return on portfolio. Okay, and so that's what really led to a great trade. So I would call that one a double. Okay, so we were hitting singles, now we have a double, and let me show you what I would consider a triple. And that was on our next trade here. I'm not going to go through all these, but I'll make this the final one. We'll talk about Campbell soup. So yes, we made money in soup. Okay. Now years ago, we always had fun with a company called Best Foods. They made mayonnaise. Okay. And man, we were making a lot of money trading delta neutral strategies on Best Foods. It was one of our favorite stocks to trade for quite a while, and all they did was make mayonnaise. And now here we're talking about soup. All right. And so on June 20th, we took this trade. Boy, Campbell's dropped like a rock on an earnings announcement. Kind of felt the stock might start trading sideways after that while traders kind of digested all the information. Did a trade with 17 days to expiration, just 3 weeks, or a little over 2 weeks, okay, to expiration, a little over 2 weeks. The trade was 16 cents. 16 cents. I got into this trade. Now we did 12 contracts, so that made our debit $192. okay, which is 1.92% return on portfolio. Now, here's what we did. We come July 5th, so last week we were busy. While everybody was celebrating the 4th of July, we were busy making money. All right, and here was the trade with 2 days left to expiration. We had a nice 137% return on portfolio in 2 weeks. All right, and I wasn't, getting that maximum profit, that's a little hard to do. I'm very happy with doubling my money or making even more than double. This is where we exited on the trade. You can see the stock came down, did test our lower break even, but then rallied up 3 days later. We're sitting pretty in this trade. And this is why, some people would say when it dropped down to this lower break even, oh my gosh, your puts are in the money. What are you going to do? What are you going to do? And, I'm sitting back going, well, I spent 16 cents on this trade. I don't really need to do anything. Okay. Where people start to worry is they traded too big. When they're worrying about their trade, they've traded too big. Okay. And so I've got this trade on $192. Ain't no thing. It's 1.9% of portfolio. And then boom, made a nice little profit. That's 2.64% return on portfolio. Okay. And you start adding those up, the 0.68 and then the 1.3 and then the 2.6. And you start adding those up and it becomes a really nice return potential on a monthly basis. So we showed this in our that trade, that when we closed that out and the next night we had our insiders meeting, and one of our um, traders who joins us on Thursday night said, "That's a super trade." I thought, wow, what a dad joke right there.
Oh
Super
my
trade,
gosh.
Campbell soup.
That's too much. Well, this sounds so you got a single, a double, you got a triple, and a lot of those trades looked real good. We got to talk sometime about the psychology of those trades as they break down to those lower and those upper limits, what you're thinking, but maybe not today. What I want to know today is what are we looking at for our next potential trade to get into,
Well,
Jeff? What are you seeing
well,
out there in the market right now?
let me show you kind of one of the lists that I use, and we'll talk about that. Let me kind of zoom in on this list real quick. What I'm looking at here is a list of stocks that fall under a cheap implied volatility level, meaning their options are not inflated in value. They're inexpensive relative to their past. Okay, and I know this is somewhat of a busy list, but just to go over a couple of names you may recognize: Levi Strauss, Pure Storage. Look at this, USO. We looked at USO a little while ago. Okay, the implied volatility is very low, which means the options premium is very low. Okay, and this is one of the lists that I look at. All right, now I also look at a quiet list. Okay, and quiet means the stock isn't moving very much. Now that could be moving sideways, not very much, moving up, not very much, or moving down, not very much. Let me show you an example. Let me pull out this and I'll get to our trade. Great example. You see how Meta is just going up, 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 up. Okay. This is considered quiet. Believe it or not. The stock is trading. Look at the daily candles here. Very nothing going on other than earnings. We had this gap on earnings. The candles are normal. There's nothing like out of a violation of a daily average move or anything like that. But this is an example of a quiet stock, and we trade these. Okay, using delta neutral strategies, we can put trades up and out in time and just let this stock walk right up into that trade. Now, sometimes the stocks go sideways, and I like looking for those. So a trade that I'm kind of looking at right now is, believe it or not, on utilities. I came up with this trade a little earlier today. Look at this. It's 16 cents for this. The potential to make $52. Now, that doesn't sound They may not sound extravagant, like great, but realize that's a 300% potential profit versus risk. Okay. Your maximum profit versus risk is over 300%, 3-to-1 risk to reward ratio on a stock that really hasn't going anywhere, and utilities usually are pretty quiet. So this is something that I'm looking at right now. This is called a calendar spread, where I'm going out in time and buying a longer term option, in this case, buying the August 18th 65 strike put, and then selling the August 4th 65 strike put. So the short term put, the one that I'm selling, expires before the long term option here. You see 25 days versus 39. And I'm just looking for this instrument to just continue to trade up and down, up and down, up and down inside, and it'll just crawl into our calendar spread, into the profit zone. And we're looking for this to make at least double our money in this trade, which is very possible. All right. So I would probably do 10 contracts on this, make it $160. That's 1.6% on our hypothetical, portfolio. And that's what we would be looking at today on as far as an opportunity in delta neutral, with a delta neutral type of strategy. This counter spread is a basic strategy, yet a little complex because we're dealing with time, two different time expirations. That takes a little bit of understanding, but other than that, it's a pretty simple trade. We're buying one leg and we're selling another. So, Brandon, anything else
I
related
like.
to that?
No, you. I mean, I'm just looking at this trade. I like simple. So we're going to be watching this over the next couple of days, obviously, and I think
Yeah.
that
Yep.
I like the potential return that you talked about here. So that's going to be something that I'm going to get excited about. That's pretty much everything that I wanted to cover today, Jeff, and I think you went over it really nicely. Is there any final words before we take off for the day? And where can people get these next trades before anybody else, Jeff?
You can sign up on our website, which is ewotrader.com, and you can subscribe to our Delta Neutral publication. You can just go up here and look at our different strategies. Come down here to Delta Neutral strategy, learn more about what we do here, and our publication. Now, the great thing about these publications is that they are delivered by both email and text alerts. Okay. And so you get alerted right away whenever we come out with with new trades. So that's where they can learn more about it and subscribe. And we would love to have you a part of our family. So but hopefully everybody enjoyed today. What I'm looking for this week is we're getting a few earnings announcements this week. Next week we'll get a few more, and it's really the next 2 weeks, next week and then the following week, where we are in the heart of earnings season, and that's why a calendar spread on XLU is timely, just because it's an ETF that is kind of an index ETF and not an individual stock name. So it doesn't have the earnings that we necessarily have to worry about. So, but that's it. So kind of a quiet week. We're looking for the markets to kind of give us some direction, but outside of that, we're just kind of sitting and watching for the next ball to drop, so to speak.
All right, thanks so much, Jeff. We'll see you guys all next week, and I appreciate all of the feedback and all of the information that you gave us today, Jeff. We'll talk to you soon.
Thanks, Brandon. Appreciate it. We'll see you guys next week.